Hello, I'm JP Powers, Chief Investment Officer at RWA Wealth Partners. Thanks for joining me for this month's market update. Let's start with an update on what we've seen in markets over the past month. After a meaningful sell-off in March, equity markets have rebounded sharply over the last several weeks and are now back near all-time highs. That move was initially driven by hopes for a de-escalation with Iran, but more recently, it's been reinforced by renewed strength in AI-related investments, semiconductors, and other high-growth areas of the market. What's notable, though, is that this hasn't been a broad-based rally, at least not yet. Leadership has been fairly concentrated in technology and higher beta names, while other parts of the market, particularly more consumer-sensitive sectors, haven't participated to the same degree. So while the headline indices look strong, underneath that, the story is more selective. And that brings us to the key question from here. Now that markets are back at these levels, we need to see strong corporate earnings results to justify them. For 2026, current expectations are for S&P 500 earnings to grow about 16.4%, compared to roughly 10% for Europe's Stock 600. That gap helps explain why US markets have led during this recovery. What's also important is how those expectations have evolved. Since January, estimates have been revised higher for both regions, despite the conflict in Iran, but the US has seen estimates increase by about 5%, while it's only been by about 3% in Europe. And those revisions haven't been evenly distributed. They've been driven largely by energy and technology, while more consumer-oriented sectors have actually seen negative revisions. So once again, we're seeing a narrower set of industries carrying the bulk of earnings growth. And with valuations once again elevated after this latest rally, the bar for companies to meet or exceed expectations is also rising. The challenge for both companies and consumers now is that the macro backdrop has become more complicated. Oil prices have moved higher again, reflecting ongoing geopolitical uncertainty and the durability of the recent ceasefire. At the same time, expectations for Federal Reserve policy have shifted. Just a couple of months ago, markets were anticipating rate cuts as soon as this summer. Today, those expectations have been pushed much further out, currently into mid-2027. Combine that with tighter lending conditions, as concerns around private credit suggest borrowing costs are likely to stay elevated, and we have businesses that are now facing pressure from both sides. It's becoming more expensive to produce as input costs rise, and more expensive to borrow as interest rates remain elevated. That combination raises important questions about corporate profit margins as we move through the year, without even mentioning the strain these conditions could put on the consumer as well. And that's shaping what's working in markets in recent weeks. You can see here the Russell 1000 growth has outperformed the value index over the last month, but those value names still hold quite a gap when you back the chart out to show the prior 6 months. In this recent environment, investors are gravitating toward companies that can continue to grow and maintain margins despite higher costs and tighter financial conditions. Historically, this means targeting businesses with strong cash flows, durable demand, and pricing power. But over the short term, this rally has been focused on some of the highest octane areas of the market, which helps explain why leadership has shifted back toward AI-driven growth and many of those infrastructure-related companies. The CapEx story related to the AI build just continues to be rewarded by investors. At the same time, sectors that are more sensitive to the consumer or more exposed to margin pressure have lagged. So the market isn't completely risk-on, it's still being selective, but going back to themes that worked well in recent years. Putting it all together, markets have rebounded quickly and are once again back near all-time highs. But after that quick bounce back, the focus might be shifting. Markets are now reassessing the rally as we get new material information almost on a daily basis. That's as we hear from companies during earnings season, as we get more clarity on the path forward from the Fed, and as the global economy adjusts to higher input costs and potentially higher borrowing costs at the same time. From here, the next leg of returns could be less about momentum and more about fundamentals and whether companies can continue to deliver in a more challenging environment that some market participants seem to be a bit complacent about. As always, we'll continue to monitor these developments closely and position your portfolios accordingly. Thanks for joining me, and we'll see you next month.